Good morning or afternoon, everyone, and welcome to the Oil and Gas Taxation 101 webinar presented by Hein and Associates. I'm Shannon Reddy, your moderator and webinar organizer today. Before we start, let's take a moment to cover a few housekeeping items. All audio lines are muted. Please use our chat feature to ask questions. We will save time at the end for Q&A. This webinar is being recorded. A copy of the webinar presentation and its recording will be sent out to all registrants later today. Your active participation is important throughout the session. In order to receive CPE for this session, you will need to be connected for a minimum of 50 minutes, and you must answer 75% of the polling questions included throughout the presentation. Immediately following this webinar, you will be directed to a survey page where you can leave comments. Please check your inbox later today for a follow-up email that contains an evaluation form that must be submitted in order to receive your CPE certificate for the course. Our presenters today are Dwayne Snyder, partner, and Ben Isley, senior manager, both in our Dallas office. Dwayne joined Hein & Associates in 2004 as a partner in the firm's tax department. He specializes in tax compliance and strategic tax planning services for both domestic and international companies. Dwayne works with clients to identify, analyze, implement, and document their various tax credit and other tax saving opportunities and assists with IRS and other tax authority examinations. He has significant experience with tax issues involved with forming partnerships and in assisting multinational companies with cross-border transactions, tax provisions, ASC 740, tax-efficient structures, due diligence, and a wide range of analysis for international acquisition and financing strategies. Over the years, Dwayne has gained a wealth of knowledge with energy and manufacturing companies and the SEC. After beginning his career with Hein and now on to Ben. After beginning his career with the Hein team as an intern in 2007, he has worked his way up to his current role as senior manager. He consults on a variety of tax planning and compliance issues, serving both the private firms and publicly traded companies. He focuses on serving clients in the oil and gas sector, real estate, and the service industry. Among other tax engagement, Ben specializes in tax provision services under ASC 740 for both private corporations and publicly traded companies. We'd like to thank you for attending today, and I'd now like to introduce Dwayne Snyder and Ben Isley.
Good morning, everybody, or good afternoon. Want to welcome everybody here. And hopefully after this presentation, we'll have we will have identified and understood the most common book-to-tax differences that the oil and gas industry face. We'll talk about some differences in the computation of tax depletion and book depletion, and learn how to identify the proper depletable property level and how to apply the AMT issues that the oil and gas industry face. We will talk about several things that the IRS require, and then we'll also consider what the industry practice is, and we'll highlight and discuss some of those issues. Wanted to start off with a little bit about the tax loopholes. The oil and gas industry has been considered to have a lot of these tax loopholes, and it was more prevalent a few years ago when oil and gas prices were very high, but even with a drop in the prices, there's still a lot of chatter about getting rid of some of these loopholes. Last year, there was an article in the Center for American Progress. It basically talked about how it's time to phase out 9 unnecessary oil and gas tax breaks. Even earlier this year, there was an article by the Washington Post that basically talked how the latest, most recent proposed tax reform had some issues with oil and gas companies that they may face and pay some of the cost for tax reform in the attempt to get a lower tax rate. The oil and gas industry would have to give up some of their tax breaks. So one thing that we'll talk a lot about is the IRS's position on certain issues. This is their market segment specialization program. Basically, if you do a Google search, you can find this handbook, and it's basically the IRS auditor's handbook is how they're supposed to address certain issues with oil and gas taxpayers. This was updated in December 3rd, 2013, so if you do look for that, make sure you're looking at the most recent version. We'll refer back to this so as an MSSP throughout this presentation. So just to start off, let's talk about some of the expenses and costs that oil and gas industry commonly face, and we'll consider how they'll treat those for GAAP and compare it to tax. And there is some differences for an independent producer versus an integrated producer on the tax side. And also there's some differences on the GAAP side between a full cost and successful efforts. So for example, contingent liabilities for GAAP, both under successful efforts and full cost, those are being deducted. However, for tax, we can't deduct those costs generally until they're actually paid. Asset retirement obligation, generally for full cost and successful efforts, they'll capitalize and deduct those costs over a time, usually through depletion. Expense for tax, they will expense when actually paid. For IDC, and this is one of the areas that often get highlighted as one of the loopholes that the oil and gas industry gets advantage. And for full costs and successful efforts, they'll capitalize and deplete those costs. But for tax, for an independent producer, we'll generally be able to deduct those costs. And for an integrated producer, generally they get to deduct 70%, and then they have to amortize 30%. So G&G costs, generally under a full cost, you'll deduct those, and successful efforts, you'll capitalize and deplete. And for tax, we'll generally capitalize and amortize those over 2 years. So one of the issues with G&G, and we'll talk about this a little bit in the future on some of these slides, is the IRS. There's a lot of contention between the IRS and the taxpayers on G&G costs. A lot of taxpayers would argue that those costs didn't have much value and should be able to be written off a lot sooner. The IRS would contend that those costs had a lot of value and even future. And so as a compromise, they came to agree that we'd capitalize and amortize those over 2 years. The issue is that even if we abandon these costs or we determine they're no longer useful, we still have to carry over the 2-year amortization. So impairment of properties under full cost and successful efforts we'll deduct, and under tax we will not deduct that. What will happen is if there's an impairment and our reserves, we no longer think our reserves are there, then in theory, we'll recover it through a faster depletion deduction, but it's not an immediate deduction for tax. Domestic production activities deduction. So this is another loophole that it's been touted that the oil and gas industry are entitled to. And this is not just entitled to the oil and gas industry, it's entitled to manufacturers and other taxpayers, but it's lumped in with one of the things that the oil and gas industry get. And so it is a permanent deduction. It's basically a phantom deduction that they put in place, and the oil and gas industry is entitled to that. A lot of other taxpayers get a 9% of their qualified net income from these activities as a deduction, whereas the oil and gas is capped at 6%. So even though the oil and gas does get it, it's not the full advantage of other taxpayers. Percentage depletion in excessive basis, there is really no concept under GAAP. Under tax, this is another one of those loopholes that's always been touted about possibly getting rid of. But in essence, it allows a depletion deduction to continue being deducted by a taxpayer long after they've fully recovered their deductions for leasehold costs and other items through regular depletion. And depletion, depreciation, and amortization, those are deducted across the board for everybody, but there are differences in how those are calculated. So again, just to summarize, the temporary differences make up most of these components. The two permanent ones are the domestic production activities deduction, or DPAD, and the percentage depletion in excess of tax basis. So let's give a quick example. Let's say that we acquire a leasehold for $600,000 and we have a $2.5 million CapEx program. And there's a slight correction to this slide. What that should be is 20% lease and well equipment and 80% IDCs. So that's what our CapEx is going to be spent on. So for tax, we will see the large deduction, the $2 million deduction is our IDC. And then we will have a much lower depletion deduction. And those are shown at the bottom. And then for GAAP, compared to GAAP, is the blue line. And so we can compare the deductions for tax versus GAAP. Now, some of the issues in this environment are that these IDCs, unless we have taxable income to shield them, they're generating NOLs. And over time, those NOLs are generally good for 20 years. If we're not able to generate taxable income to utilize those NOLs, they will fall off. But the depletion deductions often will keep going much further out. But the problem is that after 20 years, the NOL is expired. In essence, we'll have a lower tax deduction than book deduction, and it could cause us to actually pay tax in a situation where we really aren't making that much money later on in the years if we don't have an active drilling program where we're continuing to drill up. So intangible drilling costs, and this is one of the biggest advantages for oil and gas companies. Includes costs of designing, fabricating, drilling platforms, as well as direct wages, fuels, repairs, and so on. They can represent 60 to 80% of the cost of drilling a well. Investors in domestic oil and gas properties may elect to deduct those currently. And compared to other industries where they're building or creating a income-producing asset, generally other industries are required to capitalize those costs and amortize them or depreciate them. But in our case, for oil and gas producers, we get that deduction up front. There are some AMT issues and various other issues associated with that we'll talk about here in a few minutes. So as I said, non-oil and gas taxpayers who self-construct a plant or equipment or other productive property have to capitalize those costs. Often those are usually over 5, 7, or 10 years. And for GAAP, IDCs are recovered through depletion over the useful life of the well. So the deduction for IDC has been allowed in the U.S. since 1913 in order to attract investment capital in what they consider a high-risk industry. And IDCs can be deducted in the year incurred, whereas tangible drilling costs, like lease and well equipment, are amortized or depreciated over 7 years. In 2013, the Joint Committee on Taxation estimated the tax benefit of the deduction for IDCs was costing taxpayers $3.7 billion over 10 years. And this is often one of the things they cite when there's always talk about repealing this. So one thing to always consider is IDCs and workover costs are treated differently for tax, really on the AMT side. So workover costs are really used to rework or stimulate or restore production from a well. IDCs are really drilled to create a new well. And so the workover costs generally don't have the AMT preference issues that IDC do.
All right. Thank you, Ben. We are time for our first polling question. What kind of expenses are treated as intangible drilling costs for tax purposes? direct wages regarding to drilling wells, direct wages prep wells production, cost of design/fab drill platforms, or all of the above. Please make your selection now. All right, thank you for your answers, and they're listed on the screen now.
Well, very good. The correct answer was all of the above, and most people got that. So we're going to talk a little bit about depletion. All right, so here's one of the big issues in the industry is depletion is maintained on a property-by-property basis and is only deductible by persons who hold an economic interest. And so a lot of times people will try to get in where they'll get a production payment or something else associated with a well or a oil and gas property. And only if, and there's certain definitions that are required and certain characteristics that are required in order to be deemed to have an economic interest in the property. And so, you know, generally if you hold the leasehold costs outright, that's clearly there. If you have a lease, generally that's always qualifying. But the production payments often you have to get into and make sure that those will qualify. And a lot of times people will try to make the argument that a production payment is an economic interest in an oil and gas property. But if it doesn't exist for predominantly the expected life of the well or properties it's associated with, they won't necessarily qualify for an economic interest. And the big issue there is the depletion deduction. So the other thing is you can deduct the higher percentage or cost depletion on a property-by-property basis. And one property can actually qualify for percentage depletion, while another property qualifies for cost. So you don't have to do a percentage or cost for the entire oil and gas activity you have. You actually go property by property. And so one of the IRS issues is taxpayers often calculate depletion on a well-by-well basis, but a property may contain several wells or additional reserves. So this is an example of some leases that were being auctioned off by the Idaho Department of Lands. There's a little blue square that we're going to concentrate on and give you an example. Let's say we acquire 9 leases and they represent these 9 leases. So A through I are the leases. They've drilled 21 productive wells, and you can see those as the filled in triangle. And they drilled 3 dry hole costs, and those are represented by the upside down triangle without any filling. So the question is, how many properties do we have? Do we have 24, which is the total amount of wells that were drilled? Do we have 21, which are the wells that were drilled that are productive? Do we have 9 because there's 9 leases, or do we have 4? So in regards to that, go ahead.
Oh, no, sorry, Ben. I was going to say, if people could then, based on that slide, make their selection now. So how many properties were listed there? 24, 21, 9, or 4? Perfect. And you can see the results now.
So this is an area of IRS contention. The correct answer is actually 4, and we will talk about that. The industry will actually treat each well as its own property. And so the rules are that if you acquire a lease, and if you acquire it at the same time from the same person and they're contiguous, then that is one property. So for example, A through E would be one property, FG would be a second property, and H and I would be their own properties. So we have 4 properties. But industry norm is that you will see a lot of this, the depletion calculated on a well-by-well basis. And so we've dealt a lot with the IRS coming in and basically requiring taxpayers to recalculate their depletion on a property basis. The issue won't always result in additional taxes, but they consider it a compliance issue, and it is more cumbersome to have to go through these calculations, but they will argue that it's not fair for them to make the oil and gas company down the street do it and not make you do it. And so we have gotten involved in a lot of situations with taxpayers where we've helped them come about with solutions on this. A lot of times what we've been able to do is show that leases with similar names, if we can't, especially if these leases and wells have been around forever, it's hard to go back and figure out, when they were they acquired with other leases at the same time and so forth. And so there are ways that we've gone around and been able to successfully give the IRS what they've wanted in a fairly reasonable manner. And so we're going to talk about some of the issues that get raised with this. So depletion is generally based on the concept that it's an income-producing asset, and as it's depleted, they should deduct the cost of that asset to offset the income. Depletion is similar to depreciation in that the costs are deducted from income before the net income is taxed. And the way the cost depletion formula works, the total deduction will never exceed 100% over the life of the well. So it approximates an accurate deduction of capital costs. So the MSSP that I referred to earlier, which is the Oil and Gas Handbook for, sorry about that, for Oil and Gas Handbook. So here's where they come in, and this is actually directly out of the handbook. And this is their guidance to the IRS auditors when they're dealing with oil and gas taxpayer. It says, each separate tract refers to the physical area and is delineated by legal description, part of a section, section number, block, or township and range, survey, county, parish, and so forth. All contiguous areas, even those separately described, included in a single conveyance or in a separate conveyances at the same time, from the same owner, constitute a single tract or parcel of land. In practice, the agent has to determine the taxpayer's separate properties. Some taxpayers treat separate wells as separate properties. One tax property can have several wells, and all the production, income, and expenses needs to be combined to compute the depletion for that property. So the cost depletion example, basically the formula is cost depletion is equal to the current units sold divided by the current units plus the ending reserves at the end of the year, times your depletable tax base remaining as of the end of the current, or basically as of the end of the current year but before depletion for the current year. So the estimates of reserves, this is another contentious issue with the IRS. And basically, it should be according to the method current in the industry in the light of most accurate and reliable information obtainable. And this is out of the IRS handbook as well. So it says disputes with taxpayers often arise and determine the quantity of probable or prospective reserves to be included in the property's total recoverable units from oil and gas wells for purposes of depletion deduction. And so this is an area where the IRS would want you to lump everything possible in the denominator. And often with a public company or any company that issued a news release, if they touted a new acquisition that they thought had a lot of upside, and they put in their news release how much upside they thought, a lot of times the IRS would actually even go to that and compare that to the reserves we were using for the depletion deduction and challenge that why you weren't using the larger number. So in response to that, in 2004, the IRS basically allowed a safe harbor, and it basically allows them to deduct or consider the recoverable reserves equal to 105% of the proved reserves, both developed and undeveloped, as defined under specific guidance. And generally, this is the SEC guidance. So that being said, a lot of taxpayers go ahead and elect the 105% safe harbor to get this issue to go away. We have in the past been successful of allowing a taxpayer after the fact under IRS audit to go back and do the 105% in order to get rid of this issue, but that's not necessarily an indication that that's always going to be possible going forward. All right, so the percentage depletion, and this is one of the contentious areas with that people tout with oil and gas taxpayers. Basically, it allows a faster recovery potentially of the depletion deduction, but also it allows a phantom tax deduction once you've fully recovered your depletable base for taxes, in that you can continue to claim this deduction even if you don't have any oil and gas tax basis. So it's been around since 1926. Again, it bears no relation to the basis in the oil and gas reserves. It's calculated based on a percentage of gross income from the property, and it can only be taken by the property that has net income. And as I said, unlike cost depletion, percentage depletion is not limited to the depletable base of the property and can be deducted as long as the property generates income. It is not allowed for foreign oil and gas producers, domestic retailers, or domestic refiners. So the calculation is 15% of the gross income or the net income from the property. It's going to be the lower of the two. And there's two other limitations. One, the total percentage depletion deduction for the year from all your oil and gas properties can't exceed 65% of your taxable income before considering the percentage depletion deduction, DPAD, NOL carrybacks, and capital loss carrybacks, if it's a corporation. And if the average daily production exceeds 1,000 barrels, then the quantity limitation rate must be calculated. And basically, if you're producing more than 1,000 barrels of oil equivalent a day, then there is a limitation on how much percentage depletion you can take. So the differences between book and tax, just to recap: IDC costs are capitalized for GAAP and expense for tax. G&G costs are sometimes expense for book, but are always capitalized and amortized over 24 months for tax. Accretion expense is deducted for book, but is not deductible for tax. Only cash paid for asset retirement obligations for the year are deductible. An impairment of oil and gas properties are expense for book, but never deductible for tax. In essence, an impairment, especially because of a lower amount of reserves, you're just going to deplete the property a lot quicker than you otherwise would for tax. All right, so a depletion example, going back to the example where we talked about how many properties we have. So we've already talked about how the IRS and the tax law will say that you have 4 properties. The industry norm, though, again, is it's very common for people to do it at the well level. So here's an example where we're just going to concentrate on 2 different leases, F and G. They're really one property for tax purposes, but a taxpayer that calculated those as 2 separate properties, if they went through the analysis, basically percentage depletion ends up calculating $145 at the very bottom versus $110 if you treat it as one property. And that's because percentage depletion can be property, one property can claim percentage depletion, the other property can claim cost. And if you look at it under G, our calculations are showing that cost is what they're getting, but under F, they're getting percentage depletion. But if you combine the two, they're getting a lower percentage depletion. So this is just a question. Go ahead. Yes.
Sorry, I was just going to say time for another polling question. How do you currently calculate depletion? Property level, lease level, well level, or other? Please make your selection now. And here are your results.
So 50% of the people are saying they calculate it at the property level, but that leaves 50% are doing it at some other level. And again, that's not necessarily surprising. As I said, it's very common for this to not be followed, for the tax rules to not really be following what the industry average is. But a 50-50 split is higher than what we usually see. All right, at this point, I'm going to turn it over to Ben Isley. He's going to talk about G&G costs and a few other items.
Thanks, Dwayne. So yeah, I'm going to get to talk to you about the more specific details on some of the book tax differences that Dwayne discussed related to the oil and gas industry. So we're going to start with G&G, or geological and geophysical costs. These are basically the activities, the seismic surveys, the electromagnetic surveys, those kinds of activities, basically the same description that you're going to get for GAAP purposes. And really what we're going to talk about here is the treatment of them in the initial exploration phase. Some of the same activities can result in a different tax treatment in a different stage of production, but again, we're just going to focus on the initial exploration here. So the G&G, as Dwayne already has mentioned, was a contention for taxpayers. And so the compromise that they've reached was and we're going to talk about independent producers here when it talks about smaller oil and gas companies, as you read on the slide, is that we're going to capitalize and amortize over 24 months. So for major integrated oil companies, the amortization period is longer. It's 7 years. So they didn't quite, but the IRS didn't budge quite as much on that one, as is usually the case. So prior tax treatment of G&G costs, Dwayne alluded to it a little bit, is that they used to be required to be considered as capital expenditures recovered through cost depletion. But the taxpayers' argument would have been, the benefit was already seen in a prior period when we actually paid them. So this is the 24-month compromise that we're talking about. And again, this, I think Dwayne mentioned it in his initial discussion, is that this applies to successful or unsuccessful projects, just when you actually incur the cost. So again, to go back to the property definition, if you're looking at all 9 of these leases and 4 properties for tax purposes, you can have G&G on each individual property. We'll talk about the 4 properties, and you need to track the the amortization of these G&G costs by property for purposes of determining your net income for your depletion calc. Also, as Dwayne mentioned earlier on as well, if you were to abandon a property, let's say you had incurred some G&G in the initial exploration of property I, and then later fully abandon the property, the remaining G&G, if you had any to be amortized, would not be deductible when you abandon it. You would continue to amortize over the remaining period of the 24 months. So they don't let you off the hook there.
Thank you. Time for our next polling question. In the context of oil and gas exploration, what does G&G stand for? Genesis and generation, governing and guidance, geological and geophysical gold and gas. Please make your selection now. Thank you. It looks like everyone selected geological and geophysical.
So thank you for your responses there. Dwayne gave you the harder questions there. That was the "Are you awake?" question in my portion. So now we're going to talk a little bit about depreciation, specific to some of the properties that you'll see in oil and gas exploration and production. So leased well equipment is the tangible costs that we're talking about when we're completing a well. Those are generally depreciated using MACRS, or the Modified Accelerated Cost Recovery System that tax generally employs. Usually you're looking at 7-year property for leased well equipment. Straight line method could also be used, and you can actually elect to use a unit production method that ends up being similar to cost depletion. Assets that are not used in the U.S. Are generally required to be depreciated for 14 years over the straight line method. So generally what you're going to see here is you'll also see an AMT adjustment for depreciation unless you have taken bonus on that. Bonus is still eligible, or is still in effect. Obviously for 2016, for 2017, there's still 50% bonus eligible for for the lower asset life classes, which include lease and well equipment. It begins to phase out right now in 2018, down to 40% then, and then 2019 is down to 30%, and it's currently going to be phased out completely in 2020. So back to the AMT example, anything that if bonus isn't extended, then any of those future lease well equipment costs or depreciation would result in an AMT adjustment going forward once beginning in 2020, or any costs that are elected out of bonus in the current period. Back to, I wanted to touch on one thing before I skip to the next one. On depreciation, one of the things that happened in the last few years would be the repairs and maintenance regs that came out a few years ago. And I know there's some industries were hit a little bit harder with that, and it's a little more difficult to apply those regulations. What we found in the oil and gas sector is really that some of the concern about having to track all of the repairs and maintenance, by property, well by well, that may have initially felt like it was going to have to be done when the regs were issued, were kind of averted when they gave us the routine repairs and routine maintenance out. So anything that is expected to be done more than once within the AMT or the acres life of the asset. So for lease well equipment, I believe it's 10 years. And you can actually just say, okay, well, it's repairs, just based on the fact that you would expect to incur it more than once, which is very, very helpful. So those regulations haven't been as onerous on oil and gas as was initially thought. So moving on to asset retirement obligation, or ARO. Other industries will call it, remediation liability or restoration obligation. Again, Dwayne mentioned this earlier on about this is not necessarily an oil and gas only concept, although it is, the treatment of ARO is very specific, or the term ARO is very specific to oil and gas. Really, it's just the application of the contingent liability rules in the IRS related to ARO that we're looking at here. So the IRS basically says that if your liability is contingent, you don't get to deduct that expense until it becomes certain, and really that certainty is met when you get the cash payment in this case. So a quick example here that we wanted to highlight. You can look at the example here, the timeline. Let's say in 2011 you erroneously deducted book ARO in a 2011 tax return. It was filed in 2012. Then you come down the line here to 2016 when you receive a notice of the 2015 tax return audit. So a lot of times if you'd look at this, you'd look at that initially and say, okay, well, we're past the 3 years general statute of limitations that we're looking at here, so I don't really have to worry about the fact that I deducted that ARO in 2011 when the IRS comes calling on my 2015 tax return. But if you look at the IRS guidebook, the MSSP, you can see down here at that third bullet point, taxpayers failing to properly restore to income any previously amortized amounts at the time the DR&R actually occurs or when they're relieved of the liability. That's what they're talking about. The DR&R is the ARO liability in this case. They'll call it dismantlement, removal, and restoration. So they will say because it's a timing difference, even though that tax year statute of limitations is closed, they will actually take the position that they can force the taxpayer to recognize the income there in that year, in the 2015 year when they come looking at the audit. Domestic production activities deduction. Again, this is not industry specific, but the oil and gas industry does get to use it. And oil and gas extraction does qualify if you look at the regs. One of the things it is actually limited for oil and gas production. Generally, the DPAD deduction is limited to 9% of QPI, but for oil and gas activities, it's actually down to 6%. So it's actually not as advantageous for E&P as you would necessarily be led to believe by some of the things that you see in the news. So it's limited to, again, 6% of the qualified production activities income, or the lower of that, or 50% of the wages related to production, or taxable income. And a lot of times what you'll see, especially if a company is in an active drilling program, the DPAD may not necessarily apply because you may be deducting a lot of your IDCs, and your taxable income may be negligible or negative, creating NOLs as Dwayne discussed earlier. So just some terms here. QPI is the domestic production gross receipts and less cost of goods sold and other expenses allocable to the DPGR. Expenses include all expenses incurred for the production of oil and gas, IDCs, depletion, interest expense, and all properly allocable overhead applied to those properties. One thing to note here that royalties are not considered domestic production activities. We're talking about operated and non-operated working interests that apply, that get the benefit. If you're looking through at a partnership taxation here rather than a corporation, the domestic production activities deduction information should be footnoted to you on a K-1. So it's not going to be calculated on the partnership return. It would be something that is calculated at the partner level. Again, the Joint Committee of Taxation estimated the tax benefit of DPAD for oil and gas companies will save oil and gas investors $10.9 billion between 2016 and 2026, which is one of the reasons this is being a tax in the current proposals for the tax reform.
What kind of oil and gas production is not eligible for the domestic production activity deductions under 199? Marginal production on stripper wells in Oklahoma, natural gas from the Barnett Shale, oil production in Turkey, production from horizontal wells in the Permian Basin. Great, thank you very much.
And that is about what I expected on the responses there. Again, kind of a are you awake? The key there was the domestic. oil and gas production outside of the country is not eligible for that domestic production activities deduction. So we're going to talk a little bit about alternative minimum tax here and the application to the oil and gas industry. So it says here the IDC deduction is an AMT preference item. The preference equals the amount at which the IDC drilling cost, the excess intangible drilling cost for the tax year exceeds 65% of the net income from oil and gas properties. How you determine that excess IDC, that's the difference between what you deduct for tax purposes versus what the amortization for AMT purposes would be. So let me take a step back and just kind of, since this is a 101 class, the alternative minimum tax is really a separate taxing regime. So it's kind of the, piggyback on the regular income tax, but there's certain items that are calculated differently for AMT purposes versus regular tax purposes. And so you really kind of have to look at this as kind of two separate taxable income calculations. So we'll talk about AMTI being alternative minimum taxable income, which is calculated kind of concurrently but separate from taxable income. So excess IDC equals the amount by which allowable IDC paid or incurred in connection with oil and gas well exceed the amounts that would have been allowed for the tax year costs had been capitalized and amortized using straight line recovery. It does mention here the other than the cost of drilling a non-productive well. And Dwayne touched on it a little bit earlier as far as workover not being an AMT preference. So when a taxpayer is in an AMT position, AMT paying position, that's one of the planning opportunities that you can have is to look at your IDC that you're deducting on your tax return and make sure that all of those really are IDCs. There's a potential to maybe break out some of the activities and call it workover or call it dry hole costs. Then you wouldn't have the preference item on the AMT, for the IDCs, and you'd end up being able to get out of or reduce your AMT liability. So the straight line recovery method is defined as ratable amortization over a 120-month period in the well that begins on or at the election of the taxpayer, any method that would be permitted for determining cost depletion for the well. So you can use either the straight line as incurred over 120 months, 10 years, or you can actually use the same cost depletion percentage used for tax purposes on that property. We started this with saying that for AMT purposes, IDC is a preference item. So now I'm going to walk that back and I'm going to say, actually in 1992, they said that no, for independent producers, IDC is not a preference item except when you have the case that AMTI is reduced by more than 40% of AMTI computed using the full IDC preference. So we're going to walk through that example here. So the current code says no for independent producers. It is not unless you get to a certain stance. So in example one, we're going to talk about AMTI, again, alternative minimum taxable income of $1 million. $700,000 of IDC, let's assume that it's incurred evenly throughout the year. So you're looking at your IDC incurred at $700,000. The amount that would have been amortized over 10 years, because it's incurred evenly, basically you do 6 months out of the 120 months. And your initial tentative IDC preference is $665,000. Now to see if that is an AMT preference in this year, we go through this calculation where we start with our AMTI, add back our full potential preference to get 1.665 million. You multiply that times your statutory 44%, you get your max reduction in AMTI of $666,000. So you compare that to the tentative preference of $665,000, and because that is lower than your maximum reduction, you have zero preference in this case. So let's go to an example where that may not be the case. Same $700,000 of IDC, but here now we've had other expenses that reduce our AMTI to only $500,000. And so we've got the same potential preference of $665,000, and we go through the same calculation. Now AMTI, including the IDC preference, is only $1.1 million. Multiply that times your statutory 40%, and you get your maximum reduction of $466,000. So you compare that to your initial tentative preference of $665, and the overage there of the $199,000, that ends up being a preference item for AMT. So that would actually, you take your income before any of your preference items, your taxable income, you'd add back $199,000 to reach your AMTI.
So with that, I think we're running up on our end of our presentation. We wanted to allow a couple of minutes for questions, and wanted to see if anybody had any questions with regard to whatever we've talked about today. All right, so we have a question on what the interplay of the safe harbor rules with the lease and well equipment. And the safe harbor rule is the 105% of your reserves, and it really would not apply to lease and well equipment unless you were elected to recover depreciation on your lease and well equipment through depletion instead of through the 7-year depletion recovery. We've also had a question regarding, do most of our clients use the IRS property definition to complete depletion, or do they find it too burdensome? We have a mix on that. To actually go through the calculations, it does require some time and more effort. Generally, the information is a lot more readily available at the lease well, at the lease level. The well level. So we do have a mix of clients that will go ahead and continue to do it at the well level. It's just a matter of what the pain of going through an IRS audit and having to go through and recalculate that versus the pain of trying to do it, on the tax return currently. We have another question on how the property definition is handled on a royalty level. Generally, so the property definition there is whatever the royalty is tied to. Sometimes the royalties can be tied to a set of properties. Sometimes they'll tie to a specific property. And that's generally, so with the royalty, when you're conveying that or acquiring that, it would generally be under the royalties that are the properties that those are tied to. So hopefully we've answered that question. If you have, if we did not, please feel free to reach out. Another question that's come up is, in the case of tax deductible abandonment with capitalized G&G on the property, do you write off the remaining G&G basis, or do you have to continue to amortize it over the remaining life? And the answer to that was part of the compromise that the IRS came up with, is that even if you abandon some properties that have G&G on it that you haven't fully deducted, you have to continue to amortize that over that 2-year period. And that's your sole purpose of or method of recovering that cost.
Okay, so in the interest of time, I think we'll go ahead and wrap up here. Any unanswered questions, please feel free to contact us directly. We'd be happy to reach out and discuss anything that you have.
Great.
Thank you very much.
Thank you, Dwayne and Ben. For the attendees, please check your inbox for a follow-up email with an evaluation form that must be submitted in order to receive your CPE certificate for the course. Thank you again, Dwayne and Ben, and everyone have a great day. Thank you.